Hello investors, you trade stocks and options and you want to have some valuable insight from the option market as to where the stocks is going, or you want to know what type of option strategy you should use on a specific stock. One or the other, just listen up. It's going to be very useful, and we have some unique tools at EPSMomentum.com. Okay, so let's go. Implied volatility and options. This is a topic of this video. So first off, you click on the skew slope widget here and it pops up this widget with all the option info you might want to think of. Actually the useful one. So implied vol, historical vol, price, skew direction, and at various point on the volatility curve, the percentile, the sigma, everything you need is there. You can switch from 12 months to 3 months and see the various time frames. But before we delve into all these numbers, maybe we spend some time explaining what's the option, what's the skew, what's the implied vol, and how we can use it to invest in stocks. Okay, so where do we start? So we start with the skew. That's one thing, but before we go into the skew, we need to understand what's going on here and what it is exactly. On the side, you'll see the widget, and there's a couple of variables: price, implied volatility, historical volatility, and skew slope, right? So there's 5 variables, so let's go over this. First, when you trade options, you have the calls on one side, the puts on the other, and you can see the bid, the ask, and then the implied volatility for every single option. So the implied volatility is really the variable that you want to look at when you trade options, because it determines the richness or the cheapness of this specific option. So one way of displaying the implied volatility and see how expensive it is, it's to put it on some sort of a chart or a graph that looks like this. Right, so it looks like this, and the way we build that chart is we put the put on one side and a call on the other. So everything that is circled in red here is going to be on the left side. Those are the puts. That's the implied volatility of each of the puts and on all the strikes for a specific maturity. And the call side here is the right side, and it's built with this circled in green region. And so we have this curve that is tilted on one way or the other. Either it's a smile or a smirk or a skew. It's usually skewed one way. So that's why we call it the skew. So why is that useful? Because it lets you see exactly which one is expensive compared to the other. So obviously this one is kind of hypothetical, but this one is not. The second one at the bottom is actually a representation of what you have here on the option chain. The puts are high, very expensive, 57%, and the calls are low, 37%. What does that mean? It means that people are bidding on the puts and are buying puts to protect their downside, right? So that means it's going to be a pretty bearish indicator, right? Because people are buying puts to protect their downside or to betting on for betting on the downside. So how does that translate? The skew can be of many shapes, but usually when you have the calls greater than the puts, it's fairly bullish. If they're equal, kind of normal. If it's tilted to the put a little bit, actually it is very often in a normal state to be tilted to the put. The put are usually more expensive than the calls in regular times. But if the puts are, like in this example, extremely high up compared to the calls, that is really bearish, right? So again, put and calls here. Now what you do is one way to measure the steepness or the cheapness or not of the calls compared to the put is to compare 2 points on that skew. Usually the 90% moneyness and 100 trend moneyness. So it's basically 10% down and 10% up on the skew. So we compare that, and then what happened is we compare those two numbers and we say, okay, how is this ratio of the two evolving over time? But you can see that, if the put is cheaper, it's bullish, or it's flat, is neutral or normal, and if it's going down, meaning the puts are higher than the calls, it's kind of bearish, right? So how is that point in history is what we're trying to look at. So that point in history is what you have here. So this is a chart of Zoom and the implied volatility, the skew of Zoom over time, right? So the skew goes up and down and up and down, like the price goes up and down and up and down. But if you look closely, the price is in blue and the skew is in red. So the skew is this 90% moneyness to 110 moneyness ratio. And that ratio is high up here and then heads down all the way to that bottom, right? In the same time frame, the prices rally and shoots up here, right? When you usually have a bottom or top in the skew level, this is where prices are actually turning around or changing direction, okay? And we can see it here. So let's go back to our skew, the red curve. It either goes up to that point here or goes up to the second point, high up, second high, right? So same thing, the price goes from here to down. If we want to be a little more granular, it goes from this bottom to this top, and the price goes from this top to that bottom at the same time, okay? Then there's a little change of sentiment where the price rallies a little bit and then drop. Same thing here, skew rallies, meaning going down and then goes back up, right? But if you do like a shortcut, it goes from bottom to top, bottom to top, top to bottom. Same thing here, price rallies, the skew goes down, okay? When the skew finds a bottom, the price changes direction, right? The skew starts going back up, price goes down, right? And again, price is up here and goes down, and the skew as well. Skew is actually down and goes up. So the skew level is actually a description of the tension and the fear in the market. And a bottom and a top in the skew market is actually signaling a turnaround in stock price, okay? So how can we spot the turnaround in the skew? How do we get those bottoms and the turnaround in skew, right? How do we get this change of direction in the skew? Well, with the skew slope. So the skew slope is doing exactly that. So see where the skew slope is in yellow, right? And you can see the bands here. So the bands are green, very bullish, dark green, just bullish, then neutral, and then bearish and very bearish, right? So what happened is when you see the skew here, the skew slope rallying, shooting up, right? You can see the stock price here is down. The skew in red is down as well, and the stock price is rallying initially here and then dropping, right? The skew is deteriorating, right? And the stock price goes down. Okay, so let's look at this point here in yellow. The skew slope is actually shooting up, okay? Shooting up to where? It goes from the green region, somewhat very bullish, right? So it started here, and then it pushes the yellow the blue price up. It's positive, right? Why? Because the skew in red is actually getting better and better, meaning going down, right? And then all of a sudden, the skew slope shoots up because the skew also shoots up, right? And you have a huge push into the red zone, really bearish, right? Look at the price. The price goes down and down and down and down, right? So it's really very often this yellow curve is a harbinger of or predictor of where the prices are going to go. See how this shoots up into very red territory, and it leads a fall in the price, right? So this is very, very useful, and you want to be able to spot that specifically and to apply it to your portfolio. Now, if we go into what type of option strategy you can use in this case, we're trying to simplify this very nicely. I know it could be a little bit overwhelming at the beginning, but we're taking the values that we have. So price, skew, volatility, and the price expectation. Right? So the current price can be high or low. Okay, so you can have a very high price in blue here, or very low price. Okay, so if the skew here, so I repeat, the red curve is very high up and going higher, right? There is bearish pressure, and the price being high, you should expect either the price to top and then turn around, and the price to actually head lower. Okay, same thing is the skew's high and it's turning to lower, then it's a bullish signal because the skew is changing direction, right? So you expect the price to head higher, right? So this is your price expectation, heading lower, heading higher, heading lower, depending on the skew is low and lower or low or higher, right? Same thing when the price is low. Once you have your price expectation, you go to the second table. If you think the price are heading higher and the volatility is high, so you have another chart on the widget that lets you have a look at the volatility, then what do you do here? It's very simple. Heading higher, high volatility. What you do is you can safely sell puts. Why? Because the option is expensive, the volatility is high, and the stock is heading higher. So the safest bet you can do is actually sell puts, right? Or put spreads. The risky bet somewhat is to buy calls. Why is it risky? Because it's going higher anyway, that you think, right? Well, it's risky because the option is expensive, right? So it's expensive because the volatility is high. So there is a risk there, right? If you have your price going your way, okay, fine. You're good and you make a good investment. But if for any reason the price goes up very slowly and the implied vol drops, then your option might not move at all, right? So again, high volatility, heading higher, it's safe to sell puts and it's risky to buy calls. Heading lower, it's safe to sell calls and it's risky to buy puts, right? Volatility being low, it's safe to buy calls and risky to sell puts, right? Again, let's look at this reasoning. If volatility is low, the price of the option is low compared to what it should be. Okay, but you think the stock price is heading higher. Okay, so heading higher means it's in these two configuration: higher to low, high to low, or low to higher. So the skew is changing direction, right? And so in this case, you would buy some calls. That's safe to do. Vol is cheap, and you expect price to go higher, and so that's pretty good. Or the risky stuff will be to selling put. Okay, if it stays flat, then you can still a strangle here in the first one because you want to sell volatility, and you can buy a straddle because volatility is low, so you think that eventually it'll pick up on one side, one or the other. Okay, let's go back to EPSMomentum.com. This is the widget you click on, skew slope, and this will give you for Goldman Sachs what's happening on the option market. So on the widget will come up with two charts: the price, historical vol, implied vol, and the skew slope, and price and the bands. All right. So let's start at the bottom. You see the price and the implied vol and historical vol. Implied vol is in yellow and the historical vol is in red. So what you want to see is discrepancies between the historical vol in yellow and the historical vol in red and the implied vol in yellow. So see, for example, here the historical vol is higher than the implied vol. That would tend to say that the options are cheap. In fact, the stock has been flat for quite a while here, and maybe that's why, and it's not expected. All of a sudden, price shoots up, right? So so that was a good deal to buy some options here, volatility being low. Also, you see how the volatility is low compared to historical standard. I can actually remove everything and see the volatility. So how can I see that? So first, the implied volatility you see here is the 30-day implied volatility. If you want to see the 60 days, you will have a different view. So you see the 60 days point, the 90-day point, or the 100-day point, and the 10-day point. Sorry. So let's go back. Let's go back to the 30-day, which is the most followed, I would say, the first month, right? So the 30-day implied volatility is here. Okay, so what can we say here? On the implied volatility, this is this line in the table. Implied volatility, the number is 25. Percentile is 33, meaning that that point is from 0 to 100 is ranked 33. So it's fairly low. It's in the third tier, borderline to second tier, right? So first tier. So it's in lower part of implied volatility from a historical standard. Okay, so you would say implied volatility is fairly cheap here. So remember the table we just saw. That's the first conclusion you can draw from this. Then you pull up the historical volatility. Historical volatility is kind of the same. They are spot on the same. It's like 22, 25, so same thing. Historical vol is percentile 25, so it's actually it's not that much volatile. Not volatile at all compared to historical standard. And you can see how the price is being flat on the chart here. Or you can add the price and see how it is flat. So that's useful. So there's no real over or under pricing compared to historical vol, right? So that's the first conclusion you can draw from this. Okay, now let's move to the upper chart. On the upper chart, we have the price, the skew slope, the skew, and the bands. So the bands are for the skew slope. So let's remove the bands and the skew slope for now, and just focus on the price and the skew. So the price and the skew, you can see here the price in blue and the skew in red. Again, whenever we have a top in price, we have a bottom in skew. See here, top in price, bottom in skew. Top in skew, bottom in price. Okay, and you can go on and on. Like here you have almost the top or close to a top, and the price change direction. Sometimes it precedes it, sometimes there's a little bit of a lag, but it's always like that. See the top here, see the bottom there, see the top here, see the bottom there, and so on. And here there's a bottom, and then the skew runs up and up and up and up all the way, right? It actually runs up with price, which is kind of interesting. Usually when you have a rally, the price rallies, and then the implied vol start picking up. Why? Because people are accumulating position, buying the stock, and eventually they know that prices and the stock will not go to the moon, right? So what they're adding to their strategy is they're buying some puts to protect their investment. By doing so, they're pushing the puts price up and the skew goes up. That's why you have this effect where sometimes the skew actually follow the stock price, right? But so all of a sudden, the skew here drops. Why? Because people who are buying the puts, it's like, there's no way I'm gonna keep buying the puts in protection because I think the stock will go up. So what they do, they sell those puts, and the pressure on the puts drops, and it pushes price up. Right, so that is very useful. So what can we see here again? If we look at the skew is 0, 0, 1, right? So it's very low. Okay, so 0, 0, 1, and yet percentile is 683. So that is very, very low by historical standard for that full year, and interesting to see. It's actually 1.26 sigma, so 1.26 standard deviation down compared to the mean, right? And the skew slope, 5-day and 10 days. So this is basically the direction, the regression line for the last 5 days, and the regression line for the last 10 days. So see how it's actually going down because the 5 is greater than the 10. So okay, we're good on that. So now let's add the skew slope and the bands. So the skew slope here, it's really like choppy and up and down. So what we can do, you can just zoom in the last region, and see the result. So here I can see that the skew slope has been going up and down very drastically. But you see where the yellow is pushing into the green territory, right? And when you see that, price is settling and then rallying, right? See how this yellow is in green, green, except those like little spike here and there. It's in green, 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 green all the way up until here on that day, right? It goes out of the green. Well, guess what? On that day, price starts to go down and actually goes down, right? And the skew slope goes into the red, hits the red into a very bearish territory, and it goes down. Price goes down, right? As soon as the skew slope start hitting the green again, the blue line, the price, start rallying. See? It rallies, rallies, it rallies all the way. And the yellow is in either green or neutral or green or neutral. Here it's still in neutral, green, 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 old neutral, all the way to here, up to that point. On that point here, it's signaling that maybe that there's a change in perception in the market and the price should plateau or turn around. And eventually, yes, the price plateau and stop climbing. Why? Because the skew's going up, go back up here. See how the skew's dropping, dropping, dropping. Now it's flattening and actually going up. And then eventually goes down, right? And as it goes down, the skew slope goes down, hit the green again. Eventually here, price rallies, shoots up, and then drops, right? So you see how it's very, very useful to look at the skew slope because it predicts where the stock price is going. Okay? So I hope it's useful, and you can see immediately bullish, bullish, or very bullish. And if you pull up like any stock, like Tesla, you would know if it's neutral or bullish or bearish, or IBM, very bullish on some point or not, right? So IBM here is in very bullish territory, right? Skew is going down. It's actually neutral on the 30-day. On the 10-day is bullish and neutral. So eventually, the difference between 10 days, 30 days, 60 day, 90 day, 10 day is a very short volatility. So it's really the speculators and really the very short option plays. If you go into the 30, 60 days, you have a better idea as to what more long-term investors are thinking of, right? So that might be a little bit more useful. Okay, so your first question will be, okay, now this is great, but so how about you give me all the stocks that are very bullish or bullish so I can get started? Well, that's exactly what we did. So you go into the volatility bucket in the screener, and what you do is you use all the fields that you have here. The last few fields, the skew slope, status 10-day, 30-day, 60-day, and 90-day are those flags. So you would click here, and then you click on very bullish, and you click on bullish, right? And now I have just all the stocks that are either in very bullish or bullish. I can sort them. First, get the very bullish. What I can do is I can limit the market cap to just big caps. Let's pick the big names and see where we are. So we got Nvidia, very bullish. Let's have a look. So see how Nvidia obviously just shoot up, right? The skew was high up there and risky, right? But see, look, in yellow, the skew slope start touching the green. As it touches the green, price rallies. It doesn't stay neutral, price rallies, 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 goes in the green, price rallies more, right? Eventually touch a little bit of the red, so price kind of stop flat, and then goes rockets in the green, right? And the skew collapses completely, right? Look at the skew percentile. The skew percentile is 0.8 out of 100. 0.8 out of 100. It's actually the lowest point kind of ever, almost, right? See how it is over 1 year? So this is really, really bullish, right? And obviously the stock price shoots up. But you would have known a little bit earlier where this thing was going to go. Okay, so let's have a look. You know what? Why don't we remove the skew here, and we just focus on the skew slope. So see how it goes into the green here, right? So the price rallies a little bit, goes into the green, and then the price drops a little bit. It goes in the red, and the price drops. And then eventually, I don't know if you can see it here, but the skew slope start hitting the green almost and being the green, and the price starts shooting up. Okay? Same thing here. You can see the zone where the skew slope is very low, right? So here, right? So these are like buy indicators. So here, skew slope is very, very low. It's in very bullish. Look what happened. If you would have known here that it was very bullish, well, that would be a good call, right? You'll have all the way up. Look, very bullish, very bullish, very bullish, or bullish, right? And so on. So yes, it touches some bearish territory along the way, but eventually, when you see the price action here, you know, it's a good indicator to have a look at the stock. So what I usually do is you look at the skew at the same time. So see how the skew goes up, rallies to a high, and then starts to drop. That high to the drop here is what you want to see, the skew deflating. So less and less people want to buy puts. Why? Because the stock's going up, right? And then the price plateaus here because the skew rallies up, right? So this is also a bad sign. You see the price flattening. But then eventually the skew collapses. The skew slope in yellow here hit the green right on that day. And so that means price rally, right? And eventually the skew collapses and go very low. The yellow is in very bullish territory. Price shoots up, right? And so on, and you can follow. So this is very useful. You go into the screener, and that's the first flag you want to do. 10-day, 30-day, 60-day, and 90-day. That is the flag that you have, these 4 flags that you have here, okay? So that's very useful. The first line of all these indicators are there. Historical vol 10-day, 20-day, 30-day, 60-day, 90-day, 180, or implied vol 10, 20, and so on, 180. Okay, so this is useful. I also have the values of the skew for the 10-day point, 20-day, 30-day, 60-day, 90-day, and 180-day. So that is useful if you want the raw values from those variables. But then we'll start going into analytics, and this is very useful. The historical vol 30-day, 1 year, sigma 1 year. So what is this? So this is basically telling you that the 1 year historical vol and that level, is it high or not right now, right? So is it one standard deviation high, meaning the stock is very volatile or not? So if I look at Visa is 1.67 historical vol and in history, and look at that red line, 1.67. So this is an abnormal point for Visa. Visa is very volatile, and yes, in fact, Visa collapsed 5 days ago, right? So that is useful to see what stocks are doing right now, what stocks are currently very volatile or not. You can do the same thing in implied volatility. So remember, when implied volatility is expensive, that's a good way to actually sell options. When implied volatility is cheap, that's a good way or good time to buy option. So let's get to implied volatility when it is cheap, right? Okay, so here we have stocks that are very bullish, that are very cheap in implied volatility. Let's say this one, ExxonMobil, 1.48, minus 1.48, okay? And look at that. The implied volatility is at the lowest. How low? It's in the, it's actually, we picked the 30-day. So it's in the 1.61 percentile. So it's the lowest ever in the last year, almost, okay? So that is very useful. Lowest ever. Okay, so that means I could potentially buy options, calls or put, and that's a good moment to buy options, right? It's actually signaling a very bullish. Why? Because the skew collapsed completely. The skew is there at the lowest. Let's have a look at the skew. Skew is 0.4. It's the lowest of the low over the last 12 months, right? Almost. Only that point is lower. Okay, so great. So the skew's down, the slope is down, okay, and it's a good time because the implied vol is low, so good time to actually buy option, right? So what do I think of the stock? Well, then you do your own analysis. You see it's a 21, okay, EM21, and you've seen another video that's what you want to see. And then you can use the PEAD and see where the stock is actually going for the rest of the quarter. So now it's going to 58, 64, or 81 on the upper end. What we do have here is a 75% accuracy on that prediction based on 9 quarters over 37. So if I'm buying options here, if I need to buy options, one thing I can do is I can buy a call. It's pretty much at the bottom of the drift here, and I can buy a call because I know the option's cheap. I know it's a 21, right? Revision is positive. Matrix is very good. And implied vol is very good. So this is how I can find out what option to do, what option strategy I can apply here. Okay, so let's go back to our screener. Implied vol, 30-day sigma. This is very good. Now we can do the same with the skew over 1 year. Maybe the two most useful one is actually the ratio of the 30-day implied vol to historical vol, either the spread or the ratio, right? So if I do the 30-day historical vol, what does that mean? Well, if the ratio is very high, let's say 1.8, that means that the implied vol is expensive compared to the historical vol. What does that mean? That means that the implied vol is the options are pricey, right, compared to the actual volatility of the stock. The stock is not that volatile, you know, it goes up, but in a normal fashion, right? Remember, a stock that goes up $1 every day has a volatility of 0, right? Or 1% has a volatility of 0. So yeah, this is what you want to see, very high ratio from implied vol to historical vol. Okay, and then you carry on and you look at the skew, the bands, maybe over 30 days, you see how it is going. You see here in the green, price starts rallying, right? Then it hits the red. Interestingly, the skew goes up, but then retraces, right? So the yellow goes back into the green mode, which is bullish, and pushes the price up. And it hasn't really touched the red. Keep being bullish, 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 right? And all the way, it's bullish. Okay? And then you can look at the drift, put it into perspective here, and you can see it's outside the drift, so high up for the drift, but you're just a couple of days away from the quarter, right? Okay, so let's carry on. What other things you can do is the percentile ranking. This is very useful in option land. You can't really do any option work without having percentile values, right? So percentile values, you're in 90 percentile here. So I want to see Dell options here. Dell options are in 93 percentile, right? So it's the most expensive in the last year, right? See, it shoots up here. So extremely high implied vol, and you know, so that's useful to know. What else? We got skew percentile rank, and so on. We get the skew slope, 5-day and 10-day, and the implied vol slope and skew slope. So what is this? So the skew slope is actually telling you where the skew slope is going. So the skew slope is the 5-day regression line. So let's assume you want the regression line to be positive, and you want the 10-day regression line to be positive as well. Okay. So that would conflict a lot with that very bullish thing here. So let me just remove this. All right, so we have a little bit more universe. Okay. So the skew slope is the difference between the first two variables that you see. So the difference here is if it's positive, like very positive, for example, okay, it means that the 5-day is greater than 10-day. And if so, it means that the skew slope is going higher. So I click on Intel, and the skew slope going higher. So let's remove this. Let's remove the bands. Let's go over 3 months. So the skew slope is going higher. See the yellow shooting up? Okay. Why? Because the skew slope is going higher there. Right? So the skew is deteriorating. So this is a bearish sign because the skew is shooting up. So what you can do is you can do things very granular and go to the actual shape of the skew and direction of the skew. Right? So this is very useful. All these analytics are extremely useful when you take them to invest with options and implied volatility, but also married with the drift, the revisions, the holders, the matrix, and all the other tools that we have. All right. Well, I hope it was useful, and let us know if you have any questions, and we'll be happy to help you. Thank you.